this is Rachel Marshall, and today I want to talk to you about getting started with life insurance. Now, the first thing about insurance to know is that this is transferring a liability or transferring a risk to somebody other than you. So when we think about homeowners insurance or auto insurance or health insurance, we are paying the insurance company so that if something were to happen to our home, auto, or our health, and we had a high cost, we would not personally have to pay that out of our asset base. It's really the same thing when we look at life insurance. We know that if we personally did not live long enough to have the same stream of income coming into our family's life that it is today, that amount of money would be deposited into our family's personal economy regardless. So essentially, when we look at life insurance, we know that it is something that is guaranteed to happen. We are guaranteed to pass away at some point. With all the other types of insurance, we are insuring against an if type of scenario we hope will never occur to us or anyone that we know and love. When we look at life insurance, we know that we're insuring a guaranteed when event. So it will happen to us, and we don't know when. So then we can say, how do we be as prepared as possible? And how do we really think about the amount of insurance to get, what type of insurance to get, what that coverage will do for my family, and really have a good structure and frame of reference around why we're making these specific decisions. So I really want to help bring you some clarity on that. The first thing that I really want to talk about is a surprise to many people, and that is that their human life economic value is usually tremendously higher than they would have anticipated. This number is what the insurance company uses to determine how much insurance they will give you in terms of death benefit. So just for example, I want to give you an idea. If we look at the website lifehappens.org, you can go here and you can do a calculation for yourself as well. But just for example, I want to give you an idea of what the human life economic value would be for somebody who's earning $100,000 a year. Right now, they're 35 years old and they plan to continue working through age 65. That person, in a tax rate of 28%, has a human life value of $3.8 million. What does that mean exactly? That means that if they today were no longer able to continue working, that about $3.8 million is the lost income that their family would not have if they died today. So that economic value is based on your current income and the length of time that you plan to continue working until you retire. Now, something that's very important about this is that we want to plan for the worst and also be prepared in a best and worst case scenario. Life insurance is going to make sure that your family continues the standard of living that they have today. What we also want to look at is what type of insurance will give you the most advantages and allow you to have guarantees that whenever you pass away, whether that be now or 25 years from now, or possibly you live the long and healthy life and you live until you're 115. We want to plan for a scenario that works out best in every single case. So the first thing to note is that we have two types of insurance that we work with. There are many hybrids in between that I'm going to leave off the table today because I don't feel that they're pure forms of insurance that really give a clear-cut guarantee. So I'm going to talk at two ends of the spectrum. On one side, we have term insurance. Term life insurance is a simple premium paid to the insurance company for insurance over a span of time, a set number of years. And usually that's somewhere between 10 or 20 years. What that means is that it's insurance that you purchase today that if you pass away during that time frame, the death benefit is paid to your family. The problem is that if you only have term insurance and you continue living past the term, you get no benefit at all. It was a pure expense in your life. Now, I say that as a problem, but it's really not a problem because we want to live long. We just also don't want to have an unnecessary cost where we're not receiving any advantage or benefit from that. The other end of the spectrum is going to be whole life insurance. And the reason that this is different is that you get a guaranteed premium, a guaranteed death benefit, and you also have cash value as a portion of the death benefit inside the policy. So this also will continue on for your whole life. And your whole life, as defined by the insurance company, is going to be 120 years, which is the year that the policy will endow. What that means is that that year, the policy's cash value, which is the death benefit available for you to access and use inside the policy, will equal the total death benefit. And if you are still living, the policy will pay out the full amount of cash to you in your lifetime at that point when you turn 120. Now, we know that we're not probably going to live to 120, but the life expectancy is tremendously increasing, and many people are living well into their hundreds and having a great and wonderful life. So we do want to plan for having a life insurance benefit that does transfer to our heirs after that set time frame of 65 or 70 when we plan to stop working. Here's a few reasons why you want to have a guaranteed death benefit well into your hundreds. You know that you will pass on wealth to the next generation. Whole life insurance is a fantastic tool to be able to do that, as it's tax-free, as it's paid to your heirs. It also guarantees that you have life insurance on an ongoing basis and you'll never run out and have a cost only. So let's talk real briefly about what some of the benefits are inside a whole life insurance policy that make it unique and valuable. Whole life insurance is a place to store cash. The reason for that is that the cash value inside the policy is safe money that never goes down in value. It's growing at a rate of about 3 to 5% if the policy is designed well, and that's tax-free growth. And it also is liquid, meaning that you can access and use your money. It is not tied up behind bars where you cannot touch it. So you can use it, you can loan against it, you could buy a car with the cash value, you could potentially go on vacation with that money, but the most valuable use of the cash value is that you can utilize your cash value and use it to put into assets that will produce growth or cash value for you, meaning that you can get your money to work in two places for you at the same time. Now, the reason that I share this divergence between term life insurance on one side and whole life insurance on the other is that I want to help you understand the need for both. That's right, not just one and not just the other. Many people will pit life insurance, whole life versus term, and they will go to the grave saying, I only like one type of insurance. And I think that there's a tremendous value in having both, and here's why. For whole life insurance, per the amount of death benefit, you will pay more in premium. Premium is the dollars that you pay into the policy to keep the policy in force. So for instance, for the same death benefit amount, you may pay $2,000 a month for whole life, or you may pay $30 a month for term life. Remember, term life has no living benefits at all. You cannot use anything with the policy while you're alive. The only benefit of term life insurance is the death benefit paid out to your heirs when you die, if you die during the policy term. So, why have both? Well, we want to make sure that with the available dollars that you have in your personal economy, the gap between your income and your expenses, we want to make sure that most of that money is going to somewhere that you can store and have safe, liquid, growing dollars that you can use, because that is the foundation and the substance of a healthy financial life, so that not only can you qualify for loans better, you have more capital at your disposal, you can use it for emergencies or for opportunities. This is your personal reserves. This is your this is your private reserves and your personal stash of capital in your economy. Now, that's an important piece for you to have. That's why whole life insurance is an excellent place for you to store those liquid reserves. However, if we only look at life insurance as a place to store cash and we forget about insuring you for your human life value, we'll lose the opportunity to make sure that your family is taken care of in the event of a personal tragedy. What we want to do is we want to have this hybrid plan where we put together whole life insurance as your place to store cash, where your primary dollars are going into that account so that you have that safe, liquid, growing, guaranteed money. And we want to use some dollars on the side to fund term life insurance so that you can get up to the maximum human life value that you qualify for in your life. This may look like having $200,000 policy of whole life insurance and a $1.7 million policy of term life insurance. Now, another thing I want to note is that with term life insurance, we typically want to make sure that that policy is convertible. When it's convertible, that means that you will be able to, at some point in your life, whether it's an influx of capital in your life from another outside source, maybe an inheritance, or whether that's an increase in your income and you have more monthly cash flow, or whether you have a way to stop funding one whole life policy and be able to use that capital somewhere else that was monthly going towards that policy. We want to have the ability to convert term life insurance into whole life insurance. So remember that $1.7 million term policy I mentioned earlier. Perhaps you came into a position 5 years from now where you wanted to take another chunk of $300,000 of that term policy, split it off, and be able to convert that into another new whole life policy. The reason for doing this is that we want to make sure that your family is insured up to your human life value, and we want to make sure that you have the greatest asset to be able to store cash. Now, one other thing I want to mention is that a lot of times people think that they have to be the working spouse in a family in order to have human life value, and that is not true. We want to make sure that even if you're a spouse that stays home with the children, you also have life insurance. The reason for this is that if you were to be gone, there would be a tremendous additional expense for childcare, for cleaning, for all of the responsibilities that you handle on a daily basis, which may not bring a dollar amount of income into your household, but are truly an economic value. I hope this sheds some light and brings some clarity into the world of life insurance and really how to start thinking through this for your personal life in your family. I'd love to have a conversation with you if you want to talk through these ideas or figure out how it might work for you. Thank you so much, and I'll see you next time. Hi, this is Rachel. I hope you enjoyed this episode of Money Secrets. If you did, like this video, subscribe to our channel, and leave a comment below. I would like to invite you to get your free cash flow generator to help you start keeping more of your money. Come on over to marshallsinsurance.com/cashflowgenerator to sign up.